Hello everybody, welcome to another episode of Erickson TV. Curtis here with Lauren. Hey Lauren.
Hey everybody.
Hey Lauren, as you are well aware, our firm name is Erickson Wealth Tax Management.
Yes.
We talk a lot about investing, but also we also look at the tax impact of investing. And so something occurred to me the other day, which I've known intuitively because we work with long-term investors.
Right.
But the tax code actually rewards long-term investors and in some fashion penalizes short-term investors, or what we call speculators.
Right.
And what I did here is I wrote the highest tax rate an investor would have to pay taxes on for gains from their investments, and I also wrote the highest tax rate a speculator or short-term investor would have to pay on their gains in a given year.
Right. Is this because the speculator has to pay income tax on short-term gains, or is it a different tax altogether?
It's just income tax. Yeah.
It's income tax.
That's
okay.
That's the high marginal rate, and this is under current law. In 2 years from now, this is actually going to go up to nearly 40%.
Yeah, going to go higher. Okay.
Yeah, so I thought what I would do instead of looking at it from just a tax rate perspective, what the impact on the type of return an investor or speculator has to make to have the same after-tax earnings in the portfolio. So what I did is we picked out, I want to look at 3 different scenarios. The first scenario would be what I would call a modest return year, where let's say you made 5% return on your portfolio.
Right.
So go ahead and write down 5% for the investor.
Okay.
And what I'm going to write down is if you look at the speculator, what they would have to earn pre-tax to have the same after-tax return.
Okay.
And what I came up with was 6.5%.
All right. 1.5% more.
So another way of saying this, to have the same after-tax return or cash flow, this is what the speculator has to return to have the same as the investor. So that's a little bit of a difference.
And that's 1.5%. Even before expenses, very few mutual fund managers can make 1.5% better than in an average year. In fact, almost none of them do.
Yeah, and actually you brought up a good point. Mutual funds,
basically nobody does.
Active mutual funds historically have had in more recent years a turnover of at least 100% per year.
Right.
And so what does that mean they're doing?
They're speculating a lot. They're trading the entire portfolio, so they have a lot of short-term gains inside the portfolio.
All within 1 year.
Yeah.
So let's go look at a typical, more of an average year of equity stock gains of 10% per year.
Okay.
Yeah. What the speculator has to do to make the same after-tax return is make 13.1%.
That's not going to happen.
So that's huge. That's huge.
Yeah.
And then let's go to a great year in the stock market, which is 15%.
Okay,
that's a great year in the market. That has happened though.
Yes,
it can happen
sometimes.
Now we're talking about 19.62%. Huge difference.
Yeah, that's a big difference.
Right. So. I forgot to mention this, but by the way, this applies to non-retirement accounts. This would be custodial accounts. So, from looking at this, if you wanted to be a speculator, maybe where should you have your speculative money go?
Well, if you're going to be a speculator, and if somehow your speculation is going to work, which
over the long run,
over the long run, which it probably won't, but if somehow it was going to, you would definitely, if you're going to play, you want to play in your IRA.
Yeah.
You want to have your because if you speculate in a taxable account, and actually I was just talking to a woman recently who was having this exact problem because she was doing her taxes. If you speculate in a taxable account, even if you do make any money, then it gets taxed away.
Right. And then
so you really.
And then if you lose all your money, you don't get a tax.
Right. Yeah.
Okay. So I think the moral of the story is the tax code is actually decisively favoring long-term investors.
Absolutely.
All right. Well, thank you for watching this episode of Erickson TV, and we'll see you next time.
Yeah. See you next time.